Hello friends, I welcome you all to my channel. Today's topic is going to be on audit risk, material misstatements and the inherent limitations of audit. So before starting off, I would like to give you information or fun facts about auditing. Do you think we can check each and every item in the financial statement? We can check every transaction made by the client? No, it is highly impossible to do so. Do you think an auditor can give 100% assurance to the client or to the users of financial statement that he has audited each and everything? No, he can't. Why is this so? Is it possible? Firstly, it isn't possible. Why is this so? Because of the nature of auditing. Audit relies to test checking most of the times, which means you will not be able to test all the 100% items in the financial statements. All the information you have, you will not be able to check everything. You're a human being after all, right? You might miss out on some things. And also there must be time constraints and many more reasons, which we'll learn in detail in the slides coming up. So basically you can understand that audit results to test checking, which is less than 100% of checking. So because of that, you have the chances of getting a audit risk, right? Also, a auditor can only give reasonable assurance, which was very well established in the very first lecture I made. So he cannot give an absolute assurance, he can only give a reasonable assurance. But now I'm going to tell you the reason for this. The reason is because of the nature of audit, and it's because of the inherent limitation of audit, right? So guys, now let's see these slides one by one, which will help us understand each of these topics. All these topics are very important from the exam point of view. They can easily come for 4 marks each in the exam. So the second slide talks about the audit risk, right? So audit risk means the risk that the auditor expresses. We all know that the auditor, what does he do? He has to see if the financial statements are correct, right? And after that he has to express his opinion. He has to express his opinion on the same. What does an umpire in cricket match do? He sees the situation. He sees the bowler has bowled this ball. He sees that the batsman has missed the ball and hit his leg. And it's a LBW call now. The bowler is claiming for the wicket. He will judge whether it is out or not out based on his professional judgment. Okay. And then he shall give the batsman out or not out based on that. So basically he will express his opinion in the form of raising his hand for wicket and saying, nodding his head by saying no. So the same way an auditor will express his opinion the same way, right? But sometimes, as we see in cricket matches, the umpire by mistake gives a wrong opinion. How? By, if it's out, he will say not out. That's why they introduced DRS, but here there's no DRS in auditing. Okay, so that this is what audit risk means. Audit risk means the risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. See, when are the chances for the auditor making an inappropriate audit opinion? The chances will be high when the financial statements are misstated, materially misstated. If the financial statements are all correct, there are very less chance that the auditor might make a mistake. And if he makes a mistake there, it's because of his own negligence then. Then you cannot put on the term audit risk. This audit risk is that risk which the auditor cannot foresee that much, right? So basically audit risk means a risk that the auditor expresses an inappropriate. The term inappropriate is highly important over here. Inappropriate, okay? So audit expresses an inappropriate audit opinion when the financial statements are materially misstated. Only when the financial statements are materially misstated, there are chances that an auditor expresses an inappropriate audit opinion. Otherwise, it will be because of his negligence only that he gives an inappropriate audit opinion, right? So this first point is covered, I think. The second thing discussed here is audit risk cannot be reduced to zero because of the inherent limitation of audit. I already told you, each audit we will resort to test checking. Because we are resorting to test checking less than 100%, can you guarantee that you have read the financial statements as a whole? You will try your best, but it's not possible. And you'll only cover the more likely areas. You think high key areas, you'll check them properly, right? Not going to cover every area. So basically audit risk cannot be reduced to zero because of the same reason, and this is because of the inherent limitations of audit. If only there was a robo who could check each and everything, we can say that audit risk can be zero. But here we are human beings, we can tend to make mistakes, right? And then reasonable assurance is not absolute assurance, and this is also due to the inherent limitations of audit. This point is already discussed in the introduction slide. So this is what audit risk means. Let's say it one more time. So audit risk means the risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. What is materially misstated is the next slide. Okay. Audit risk cannot be reduced to zero. Okay, whatever happens, it cannot be reduced to zero because of the inherent limitations of audit. Same way, reasonable assurance, which means less than 100% assurance, is not absolute assurance, which is 100% assurance, and this is due to what? Again, the inherent limitations of audit. Now, the next slide will cover material misstatements. So, what are material misstatements? A material misstatement is information in the financial statements. Information in the financial statements. So financial statements, you know what it is: balance sheet, P&L, all these things. So what is information in the financial statements? Maybe in trading account you have purchases, sales, salary, wages, all these things, right? In trading and P&L account. Balance sheet you have assets. In assets you have current assets. So all these information on regarding current assets, regarding sales, regarding purchases. So this is what information means, okay? And financial statements, balance sheet, P&L, and all the other things. That is sufficiently incorrect. That means which is materially incorrect. Small things like you missed out a 20 rupees expense, that will not be a matter. Sufficiently incorrect, which is not just incorrect, it is 100% incorrect. You're sure that you have missed out something. Okay, you're not sure, basically you have clearly missed out something. It is good enough to say you have materially misstated. Okay, that it may impact the economic decisions of someone relying on those statements. So basically, let's understand who sees these financial statements. Firstly, you're a general consumer, okay, and you look into the stocks and shares of some certain company you want to invest in. If that company, okay, values its income or revenue higher than it actually is in the financial statements, you will tend to be a potential buyer in that company's shares, right? And you will invest in that company and you will buy the shares of that company. But when you will actually get to know the company is only window dressed the situation, then what will happen to you? You will end up losing money in the end, right? Because the price of the stock will definitely decline someday because it's all window dressed, right? So that is what you have to understand here, that if you are, when you will call material misstatement, when the impact is such that it will affect the economic decisions of the someone relying on the financial statements. Who are the people? Government relies, employees of the company will rely, and many more people like the staffs, the employees, as I said, and any the financial institutions like banks, all of them will rely because they have to see if they can give you loans or not, right? So basically all these institutions, financial institutions, credit rating agencies, all of these people will definitely rely on the financial statements. And if you have window dressed your financial statement, what will happen? They will get a wrong view, a wrong picture of your financial statements, because of which they might invest or they might give you the loan. So such decision which might impact the economic decisions of these users, okay, and it is sufficiently incorrect, then it is called a material misstatement, right? So a material misstatement is information in the financial statement that is sufficiently incorrect that it may impact the economic decisions of someone relying on the statements, right? Example I gave you my own, but this is the same thing here. A material misstatement of revenue could trigger what? A decision to buy a company's shares, causing loss for the investor when the misstatement is later corrected and the price of the stock anyway decline, right? So I hope that example is clear. And then when an auditor, what should you as an auditor do when you find such a material misstatement? That's a very important question. So when an auditor, when you find a material misstatement, you should firstly go and tell the management about it. You should inquire and tell the management that I have gone through these accounts, I've gone through these information, your financial statements. I feel that there's some material misstatement over here. Please, I want to set up an inquiry for the same. Now, if the management responds by saying that, okay, we shall correct it and we shall declare it publicly that this went wrong and we will make the required changes for the same. If he tells this to you, then you should go ahead and give him a proper opinion. Okay, but they should clearly state by a note that they have made this error to the public domain. Okay, so that the decisions of the users is not impacted and they will have to face the legal consequences later on, of course. But you can still give a unmodified opinion, that is opinion without any kind of error. Okay, that everything was good and whatever I suggested to them, they properly followed it. Okay, but if the management comes and tells you we cannot correct it, if he says you this, then what will you do? Then as an auditor you should evaluate the effect of misstatement, evaluate the effect of this misstatement on the financial statement, and you have to apply your own professional judgment. What is professional judgment we will learn in detail later on in the next videos, but to give it I can just tell you professional judgment means every person has his own thought process, has his own set of skills, his own set of mindset, how he reacts to different situation. So professional judgment means his own thoughts, his own mind he should apply, and he has to decide whether it is necessary for him to modify his or her audit opinion. What do you mean by modifying the opinion? Now, in report card, when you used to get your report card in your school days and your college days, if you got very bad marks, the teacher will not just give you the bad marks, he'll also write down a note there. Please ask your son or daughter to study properly. He has done this wrong. He is very weak in this subject. They'll modify your report card. The same way, as an auditor, you will modify your audit opinion. Okay, by telling that this was wrong. He has this client is not showing these details. All this you put in your audit opinion. So this is what material misstatement means as a whole. I hope this whole topic is clear. Now let's come to the inherent limitations of audit. What are the inherent limitations of audit? So basically guys, first topic we discussed is audit risk, in which we had this term that reasonable assurance is not absolute assurance because of the inherent limitations of audit, right? So what are these inherent limitations of audit? Nature of financial reporting, nature of audit procedures, and limitations with respect to time and cost are the 3 points we're going to discuss in inherent limitations of audit. This question is a very highly important question in your examination perspective. It has come up more times than I can remember. So please cover this topic properly. Nature of financial reporting. See, financial reporting's nature, if you see, who makes, I told you already that who makes the financial statement. The financial statement is made by the management. So that management will include managers, of course. So the managers will apply their professional judgment, their financial judgment, and they'll prepare according to their thought process, right? So the preparation of this FS involves financial judgment by the management, correct? So this is the first point, because it is done by the management and is as per their financial judgment. And these are subjective decisions. This cannot be said as a conclusive or a decision of a whole group of people. It is a decision of one or two people, right? And it cannot be the same. The thought process will be different collectively in a group, if you see. But this is an individually subjective decision. Evidence with respect to such items can only be persuasive, they are not conclusive. Suppose you take example as accounting estimates. In accounting estimates, one person will estimate in this way, other person will estimate in that way. This is going to be very subjective. It is their choice to estimate in this way or that way, but they have to just put a disclosure for the same, right? So it's going to be subjective decisions, and because of this, there cannot be exact evidences for such items, and this can only be persuasive. They are not conclusive. You will never get a conclusive evidence because of the nature of financial reporting. So basically, in the topic nature of financial reporting, you can understand, because the management is making the preparing the financial statements, it involves a financial judgment, right? And basically Preparation involves subjective decisions. Example, accounting estimates. And evidences with respect to such items can only be persuasive. It cannot be conclusive. So this topic is done. Now, nature of the audit procedures. What do you mean by the nature of audit procedures? Basically, now when you went for audit, you found some problem. You told to the client, I want this. Client or the manager, you went and told that I want this information. He refuses to give you. So the management or others may not provide complete information to you. When you go ask also, they might not provide. In such a case, what will you do? I already told you, you will modify the opinion. But here, one of the limitation of audit is this only, right? Moreover, funds may involve carefully designed scheme to conceal it, and thus the auditor may not detect them. See, basically, auditing involves a lot of skills. It involves the skills to bring out the fraud and errors to the limelight. Okay, but as an auditor, you will never be able to guarantee, okay, how a thief thinks, right? So basically, the client here, I'm not calling him a thief, but they are very clever. So they in some ways they are very much capable of designing or properly executing a plan on deliberately concealing a material misstatement and deliberately concealing a fraud they have done. Okay, and because you are going to just audit the financial statements, it may sometimes come to the notice that you will not be able to detect or prevent them, right? So that is what this point is telling, that moreover the funds may involve carefully designed scheme to conceal it, and thus the auditor may not detect them. If it is a master plan by the client, then sometimes you might not be able to detect the fraud. So that is one of the inherent limitation of audit. Now, limitations with respect to time and cost. The users expect that auditor will form an opinion on financial statements within reasonable time and cost. As a user of financial statement, Tata company, you want to invest. What are you expecting? So that you are expecting that the auditor of Tata will form an opinion as quick as possible. So based on that opinion, you will either decide you have to invest or not, right? So the users are eagerly waiting for the auditor's opinion on the company or the client, right? Thus, auditor resorts to test checking. Because of this, that the users are waiting, he also has his own time bounds. He has other clients to attend. So it's highly impossible that he gives 100% checking. So the auditor will resort to test checking only. That is less than 100%, right? Moreover, he directs his attention to more efforts or to risky areas. So basically, he directs more efforts to the risky areas. He will maybe check the inventory because inventory is a risky area. He'll check the sales, the purchases, the drawings. So basically, as an auditor, you will not give equal attention to all the things. You will give attention to those areas which you think are highly risky areas where the chances of fraud are the most. So with this, we can say the inherent limitations of audit are three things: nature of financial reporting, nature of audit procedures, and it can be with respect to limitations with respect to time and cost. So very simple: nature of financial reporting, nature of audit procedures, limitation with respect to time and cost. So in these slides, we covered audit risk, material misstatement, and inherent limitations of audit. If you have any doubts, please feel free to reach out to me regarding the same. And thank you so much. Please do like, subscribe, and share my channel to your friends, and do show your support in the comment section by commenting whatever your thoughts are on the video. And you can please put suggestions for videos for the coming up days. I shall take them into consideration while uploading the next one. Thank you so much. Goodbye, friends. Bye.